Let me start with a fact most investors never hear clearly explained. Over the last several decades, the majority of stock market returns have come from dividends and reinvested income, not price appreciation alone. But here's the other side of that same fact. Most dividend cuts happen during market stress, exactly when retirees need income the most. And that creates a serious problem. Because getting a 5% dividend yield is actually easy. Getting a reliable, repeatable, sustainable 5% income stream without blowing up your principal, that's the hardest part. And today, that's exactly what we're going to talk about. In this video, I'm going to walk you through how to build a 5% dividend-focused portfolio using large cap, more stable dividend stocks combined with fixed income vehicles and income stabilizers, so you're not forced to take unnecessary risk just to hit an income number. This is not about chasing yield. This is about building income you can actually depend on. Now, before we go any further, take a second and subscribe to the channel by clicking the subscribe button below. If you're near or in retirement, or you care about some income or stability or clarity with your money, this channel is built for you. All right, let's get into it. When most people say, I want a 5% dividend portfolio, what they usually mean is, I want my money to pay me about 5% per year. And that's reasonable. There's nothing aggressive or reckless about that goal. But here's where the mistake happens. Most investors immediately go to a stock screener, filter by dividend yield, sort from highest to lowest, and start buying whatever shows up at the top of the list. And that's how people end up with portfolios that look great on paper right up until the dividend gets cut and the stock prices collapse. Here's the key point you need to understand. Dividend yield is a ratio, not a promise. Dividend yield goes up for two reasons. One reason is good, the other reason is dangerous. Reason number one, the company is profitable, cash flow is strong, and management intentionally pays a meaningful portion of earnings to shareholders. That's healthy dividend income. Reason number two, the stock price has fallen sharply, often because the business is struggling and the dividend hasn't been cut yet. That's a yield trap. And the market is full of yield traps. If you buy a stock yielding 8% and it cuts the dividend by half and the stock price falls another 30%, you didn't get income. You just converted risk into a permanent loss. This is why income planning is not yield shopping. Income planning is about durability. It's about asking, will this income still be here during a recession, during a bear market, during a credit crunch, during rising rates, during falling rates? Because retirement income doesn't get to take years off. Now, most people think the bigger risk in dividend investing is volatility, and it's not. The biggest risks are, number one, dividend cuts. Number two, permanent loss of principal. And number three, being forced to sell assets at the wrong time. Volatility is uncomfortable. Those three things are destructive. If your portfolio drops temporarily, but the income stays intact, you can usually ride it out. If your income disappears and you're forced to sell shares to pay bills, you've changed the entire trajectory of your retirement. So the goal is not maximizing yield. The goal is building income that survives bad environments. And that requires structure. Now, the framework I want to share with you is what I call a 3-layer income portfolio. Instead of asking one type of investment to do all the work, we assign different jobs to different layers. Here are the 3 layers. Layer 1, the dividend core, large cap, higher quality dividend stocks. Layer 2, the income stabilizers, fixed income and bond-like vehicles designed to reduce volatility and income disruptions. And then layer 3, we use yield enhancers, used carefully to bridge the gap toward the 5% without turning the portfolio into a high-risk experiment. This structure matters because the safest way to reach a 5% income target is not to push every holding to 5%. It's to blend income sources intelligently. Now, there's one way of looking at this. We could look at the first layer, and layer 1 is the foundation. This is where you focus on quality over yield. Large cap dividend stocks tend to offer established business models, diversified revenue streams, better access to capital, longer operating histories, and often stronger commitment to dividends. These are not the most exciting stocks in the market, but that's a feature, not a bug, because retirement income does not need excitement. It needs consistency. When evaluating dividend stocks for the core, there are 5 things that matter more than yield. First, cash flow coverage. Dividends are paid with cash, not opinions. Second, payout ratio. If a company is paying out nearly everything it earns, there's no margin for error. Third, balance sheet strength. Too much debt creates vulnerability, especially when interest rates change. Fourth, business durability. You want products and services people buy even when money gets tight. Fifth, dividend culture. Some companies treat dividends as optional, others treat them as a priority. You want the second group. Now, while no sector is perfect, we want to also diversify that dividend portfolio through different sectors, and sectors that often play a role in that core. So certain areas of the market have historically produced more reliable dividend income, such as consumer staples, healthcare, certain utilities, select financials, some integrated energy companies, and telecom with some caution. The goal is not to load up on one particular sector. The goal is diversification. A single regulatory change, technology shift, or pricing disruption should never threaten your entire income stream. So as a rule of thumb, no single stock should dominate your portfolio, and no single sector should dominate your income. Now, there are 2 main ways people build the dividend core. Option 1 is using dividend-focused ETFs. These can provide instant diversification, professional screening, and reduce single company risk. The trade-off is that yields are often lower, and you give up control over individual holdings. Option 2 is building a basket of individual stocks. This allows for customized income targeting, tax planning flexibility, and tighter risk controls, but it requires discipline and monitoring. Neither approach is better. The right approach depends on your involvement level, account type, and the personal preference. What matters is that layer 1 is built for durability, not maximum yield. Now, here's an important reality check. A high quality, large cap dividend core will often yield somewhere between 2.5% to 4.5%, and that's normal. Trying to force it higher is usually where risk creeps in, which is why we move to layer 2. Layer 2 is the income stabilizers. Layer 2 exists for one primary reason: to reduce the chance that you're forced to sell stocks during a bad market. This layer includes things like treasuries, investment-grade bonds, CDs, bond ladders, certain income-oriented funds. These assets tend to produce steadier cash flow, reduce overall portfolio volatility, and provide liquidity when stocks struggle. They may not excite you, but that's the point. They are the shock absorbers of your portfolio. Now, why fixed income still matters? There's a narrative that bonds are dead or unnecessary. That narrative ignores how retirement income works. Bonds don't exist to beat stocks. They exist to change the behavior under stress. If fixed income allows you to avoid selling stocks during downturns, it has done its job. Even modest yields can be powerful when paired with stability. Then there's layer 3. Layer 3 is optional, but powerful if used correctly. This layer may include covered call strategies, select higher yield dividend sectors, income-oriented funds, or if you've heard me talk before, we've looked at structured banknotes. The key word is limited. This layer is not the foundation, it is the dial. Used sparingly, it helps bridge from the 3 to 4% toward the 5%. Used aggressively, it introduces risk that often shows up at the worst possible time. So let's look at how this might come together. Example 1, let's say I have a more conservative income focus. We'll put about 55% in a dividend core, about 35% in income stabilizers, and about 10% in yield enhancers. Example 2, let's say I want more balanced income. Around 60% would go in the dividend core, 25% in the stabilizers, and 15% in the yield enhancers. And then one more, example 3, more equity exposure. 70% dividend core, 10% stabilizers, 20% yield enhancers. The right mix all depends on your time horizon, your spending needs, emotional tolerance, and tax considerations. Yield targets alone should never dictate structure. Now, before investing in any income asset, ask these questions. Is the income supported by cash flow? Is the balance sheet strong? How did the investment perform during stress periods? What would cause the income to decline? What role does this play in the portfolio? If you can't answer those questions, you're just guessing. Now, there are some of the biggest mistakes investors make, and that is chasing yield, over concentrating in one sector, ignoring total return, underestimating interest rate risk, and operating without rules. Rules protect you when emotions are loud. So how do you manage a dividend portfolio over time? Now, income portfolios are not a set and forget it type of strategy. They do require periodic reviews, rebalancing, and ongoing risk assessment. Dividends change, businesses evolve, and markets shift. Your process must adapt without becoming reactive. So let's bring it all together. Yes, a 5% dividend-focused portfolio can be built without taking on excessive risk, but only if you stop thinking in terms of yield and start thinking in terms of structure. Large cap dividend stocks provide the engine, fixed income provides the stability, and yield enhancers the fine tuning. Blend them all properly, and income becomes something you manage, not something you chase. Now, if you want help applying this framework to your personal situation, your taxes, your accounts, your income needs, and your comfort with risk, you can always book a meeting with us here by clicking the link below, and we'll walk through what you have, what you need, and whether your current portfolio is actually built to support reliable income. No pressure, just clarity. And if this video helps you, make sure you're subscribed. More income-focused education is coming. Thanks for watching, and I'll see you in the next one.